we go. Think we got some audio? Matt, you hear me? There we go. I think we're there now. Okay. So, market getting pummeled, but the cloud stocks have been the main issue. Now, what's going to be a bigger problem is if the S&P 500 generally follows the chart. Yeah. Okay, we're on here. Okay, hold on. I'll swing it back around.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Okay, we're back in business here. Tell me how that sounds over there, Matt. Like I said, busy day. Okay, let's run through the chart real quick. Here's what I'm most concerned about is the fact that the S&P 500 is making a bearish divergence right now. This is the same pattern that I was pointing out for Bitcoin that I was concerned about. The fact that we've been trying to punch through 7,000 but haven't been able to is a major issue. When you see the RSI on the bottom panel making lower highs, that tells you that each incremental push has gotten weaker. That's not a good thing. It traces back actually to September. If you look at the line on the bottom panel, we've been seeing momentum drop off. Even though stocks have been trying so hard to punch through that 7,000 technical level, it hasn't happened. And so basically what this tells me is that if the S&P 500 is going to need a pullback, then it's going to take us to about 6,600. There's a few other reasons for concern. I'm not really as concerned about the cloud stuff as I was talking about, but my mic was off, is that the cloud things have been part of a rotation. Rotation in markets is okay. Obviously, you don't want total destruction of tech, but the sideways action that we've seen for months in the Mag 7 presents an opportunity for equities to revalue cheaper and create more value and opportunity. That being said, lines are starting to break. I don't like the chart for Mags breaking below 62 bucks. The other thing that I got wrong the last week is bonds. Bond yields are coming off now in a substantial way. I thought we'd stay above 4.2%, but we haven't. Instead, bonds have rallied, especially on the back of very good data, which is what we got in the form of jobs yesterday. You're not supposed to rally bonds on that good of a number. So that tells me there's some risk-off appetite coming into bonds. That's why I think it's important to revisit the risk radar here, because what it's looked like over the last couple of weeks has been this. It's been red for Bitcoin, red for bonds, red for dollar, green for gold. But there's two things here I think we have to reconsider. Namely, is the sell-off in metals that now has a lower highs and lower lows situation for silver, and gold, which has been trying to hang in but is now getting wrapped up in some of the risk off that we've seen in coins. So for the first time in a long time, my green light for gold goes yellow, but bonds I also have to change to yellow as well. The dollar too. So let me hit a few more charts real quick before I bring in Mr. Brent Kochuba, who's standing by. Look at the dollar holding up here. It's actually not bad. The fact that the dollar has been hanging in tells us that maybe people are looking at the dollar as a potential risk-off play and a place to hide out. The fact also that bonds have caught a bid too tells us again that there might be some risk-off appetite. If you look at gold, it's not bad. You still have the uptrend in gold. But if you look at silver, which has been the risk on, you now have lower highs on the chart. If you make lower lows in silver by dropping below 70 bucks, then it looks like we're just kind of going through popping some bubbles that started with crypto, moved to metals, then hit cloud, and maybe it has to drag the S&P 500 down a couple hundred points to reset from that perspective. So for the time being, there is a lot of yellow on my risk radar apart from the red and Bitcoin, which has been the most reliable trend. All right, let's bring in Mr. Brent Kochuba joining me from SpotGamma on the move. All right, now we're jamming here, Brent. Look, Brent, the S&P 500 is so close to all-time highs, it's hard to make a big deal out of it, but I do get a little bit concerned that perhaps, we might have some further downside here. Tell me what you're looking at. Oh, I lost Brent.
Oliver, so I have a couple connectivity issues here, so hopefully you can hear me.
Hey, I hear you. I hear you. We'll look at a static Kochuba as long as we can hear your voice.
Hey, okay, sorry about the connectivity issues. Okay,
talk
cool.
to me.
Couple interesting things about the so a couple of interesting things about today's market. Number one, yesterday is weak in the S&P, but we've seen this how many times over the last couple of weeks where we moved down to 6,800, even below. Tomorrow we're at 69, right? So there is this mean reversion that is still in the market, and the reason I bring that up today is because
oh, we lost you at mean reversion, Brent. Oh, we might have lost Kochuba. Okay, that's all right. We'll swing him back around. I'm going to bring up the chart that he's talking about here because, to his point, there might be a fairly serious issue if the S&P 500 cracks through 69 to the downside as we've been looking at. But overall, as we hang in with the S&P 500 so close, maybe there's some hope here that we can stabilize. I'll try and stabilize Brent's connection and get back here in a minute. Be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, let's try that again, Mr. Kochuba. We're troubleshooting. You're on the move. We're having internet outages. What's up? Hey, I think we hear him. We see him.
All right.
There we go. All right, let's do the speed round of SpotGamma volatility. Tell me what you're looking at, Brent.
Yeah, let's go quick. So today was a lot of zero DTE trading, and I know I blame a lot of moves on zero DTE trading, but today was specifically about $5 billion of spider calls, SPY calls, sold for today's expiration and next expiration. That's a lot of size, and there was an algo that started right at 10:30, and you could see it, and it turned off right at 11 as S&P hit 6850. So that was the intraday pressure. Now, that is bearish in the short term, which suggests to me that we get this kind of bounce back into the 6,900 that we have seen play out how many times all over the last kind of 2 weeks, right? We see that move, yes, or maybe even a bit below, and then lo and behold, a couple days later, we're right back to 6,900. So I kind of think that dynamic is still in play. Now, that being said, there is absolutely now a bid in put skew. We're seeing put skew move to statistical significance. What do I mean by that? Puts are getting bought up now in a way that we haven't seen recently. So there is some hedging coming in, and a lot of those leading trades are kind of breaking down. You talk about gold and crypto. And what I wonder there is if you look at rates, right, the expectations of rate cuts went from, leaning to 20% chance of a rate cut. Right now we're back to 10% after that jobs data. So there's some macro shifts certainly happening that I think are a bigger picture. Ultimately, what I think is if we're going to look for downside, it may be a little bit easier as we move to VIX expiration next week. But right now, I think that kind of bottom or the underside of this market is certainly starting to kind of peel away or crumble. You know, the software story looked like it was due for a bounce. We had stories like App again. App yesterday reported terrible earnings. It's down 20%, just like Unity the day before. So it's kind of hard to find any kind of leadership. And Oliver, if you want to see an ugly chart, bring up the MAGS, MAGS. I mean, this thing looks like it's about to just puke. So we're wearing away, I think, the bottom support. I do think that not quite yet. I don't want to get too cute with it, but you really got to worry about kind of next week with OPEX that things really maybe start to crack. And on that point, if we're under 6,900, I think you got to start to favor that ultimate crack, right? Because that negative gamma dynamic starts to pick up, and as VIX and vol starts to move higher, it starts to move us back into that spasmy kind of market. And so, to your point of your risk radar, things are starting to look a little bit chippy, and downside as we get towards OPEX may be a little bit stickier than we've seen. So maybe not today, but certainly as we creep towards next week, I think that becomes a little more realistic.
Yeah, the level that shows up, I'm looking at SpotGamma, put wall at 68.19, so maybe we've got a little bit more breathing room here, Brent, to some extent, but boy, it does seem like 66 beckons if we can't go higher.
Yeah, and that 66 area, 6,600 area is where negative gamma really dissipates in the S&P 500. So that would be the area where you start to say, okay, the options market's not going to push this thing any further. Once again, we get to that kind of zone. So there is definitely a chance of a 3 to 5% downside here, but I would look at this more as like a next week thing as opposed to maybe this week. I wouldn't want to get too cute with that kind of that forecast, but OPEX would certainly loosen things up, I think, as opposed to make things stickier. Okay.
Brent, thinking about the news flow, this week it seemed like jobs were okay. It seemed like, to your point, a lot of earnings blow-ups. So I feel like we probably blame this mostly on stock specifics at this point rather than kind of the macro. But in terms of maybe rotation, is there hope? Do you see any flows into any of the other stuff that was helping keep us afloat when we were looking at, say, small caps or industrials or defense? Is there anything that's getting a lot of options flows that might not be the big tech names right now? Because we know it's not them, at least on the call side.
The only thing that looks slightly decent right now is energy, which was having quite a nice bid, right? You can see those stocks are moving up quite nicely. And then it's these memory names, Micron, SanDisk. Those things are looking good. And outside of that, it's quite hard to find a pocket of bullishness, right? A place where you want to maybe express some upside. And we're making the argument that volatility was becoming an interesting trade in some of these semi names, right? Or excuse me, in some of the software names. And if you look at like an AppLovin, which is down a lot today, vol still came in there. Now that's not going to help this thing directionally, but ultimately the struggle is real here, right? To find a vector of bullishness. It just doesn't exist at this moment. And the volatility in the index side isn't so interesting that becomes the bullish asset class, right? But if you start to get the S&P to 6,600-ish and you get VIX around 30, then you go, okay, I'm going to sell some vol premium here, which can help to stabilize the market because there is enough vol premium. So, we need something to sort of, something for people to look at to express bullish upside, either selling vol or buying stocks. And, right now, neither seem interesting. If anything, everything seems a little bit poised to go the other way, a la stocks lower and vol higher. And I think that's going to be true. You want to lean that way while we're under 6,900.
Yeah. Okay. So we're kind of playing with fire here under 6,900, hoping that maybe Nvidia in a couple of weeks can come to the rescue. That's one way for it to happen, but it's going to be tricky. Brent, like the technical analysis, appreciate it. Glad we got you. Thanks for jumping on.
Thanks, Oliver. Sorry for all the tech issues.
No, all good. It was both ends, both sides. Brent Kochuba, SpotGamma. All right, we need to get out of the 6,900 realm and move back higher if we need to get this market to hang in instead of breaking down, because it certainly is breaking down right now. The fact that we've got bonds rallying too, another one of those signs that the market is running out of ideas. The software blow-up, of course, has been a very big part of it. I know Marc Lopresti has been watching it very carefully from Market Rebellion. He's on the line. He's in the Zoom. Let's get him in. Mark, what's going on, man?
Good to see you, buddy. Tough day.
Yeah, market flailing here. Tough day for market, tough day for my technical setup here, but we're back in it and we're cruising. The software bloodbath, Mark, I've been generally somewhat dismissive of for the last couple of weeks because I felt that it was heralded like a year ago when all these companies in the cloud space were very expensive. A lot of them are layered with a lot of acquisitions over the years and inefficiencies, I feel like, and AI naturally cuts through a lot of that. Do you think it has potential blowback for the economy, though?
Yeah, I do, Oliver. We've been calling it the SaaSpocalypse or the Claude crash. And listen, I have to admit, I have become a bit of a Claude enthusiast. And that was before the update that they dropped last week. If you're in any type of part of the software business, the SaaS business, that includes dev or custom dev as part of your main deliverable, you've got to be pretty darn scared. You just don't need it the way you did before because of some of the tools. I mean, Anthropic announcing, by the way, today, as I'm sure you probably already covered, $30 billion inflection of cash and an almost $400 billion valuation. That's one of the private companies that we're keeping an eye on as a potential IPO. Probably not this year, because I think they'll probably want to see a valuation closer to a T. And I think they'll get there. But I don't think, at least as the SaaS story is concerned, I do not think it's overblown. I think what's going on right now is a bit more of a value rotation on all kinds of different reasons, not just the SaaSpocalypse. We're seeing a ton of weakness in the small cap names. We're seeing a ton of weakness in a lot of the growth areas that we remain very bullish on this year, Oliver, whether it's space, whether it's quantum. Look, Elon's going to take that thing public this year. It's going to happen, and it's probably going to happen before the midterms. So do I think that those macro themes that we've been so bullish about have suddenly gone away because of what we're looking at right now in terms of this sell-off in technology? The answer is no. We might even be looking to see that some things might look like they're on sale at these prices. But as you were just discussing with your last guest, we are paying very close attention to the index level technicals that indicate to us, especially if we go into tomorrow, the long weekend, the government shutdown or partial shutdown looming, that we might leg even lower before things get better.
6,600 we were looking at as potentially maybe a leg to find some support at, where the S&P found support October, November last year. To your point though, Mark, the fade in some of the small caps, the fade in the financials, break down really in banks, a few groups that had been holding up very well. The only thing that's really working on my thematic list today is ITA, which is defense,
and energy,
home
probably.
builders, and energy, which is an interesting point. John brought that to my attention yesterday. Let's revisit that one real quick. ExxonMobil move, incredible. Crude oil back down today, but we kind of knew it was going to chop here around the mid-60s. Give me your thoughts on that. Is that a sustainable, is that a trade through here, or is that just too risky dabbling in the oil patch?
Listen, look, it's an industry that I love. It's an industry that I've been personally invested in, particularly, as you mentioned, in the patch in the Permian Basin. But we are in sort of a fundamental structural supply, pretty handily outpacing demand, and that is anticipated to continue for the foreseeable future, probably through the end of this year. You can't have a combination of like what went on in Venezuela, anticipated decreasing demand from places like China, where industrial output, as the impact of tariffs is felt, and GDP continues to have a lot of pressure on the downside. And also what we've seen and what we can expect to continue to see out of OPEC, oil prices are going to remain, which is great for consumers and great for folks at the pump, but not necessarily so great for the producers or even for the midstream players. And yet we are seeing this strength in the space. I think it's a little bit of a harder one to play in the longer term when you just look at that basic supply-demand construct.
I'm looking at gas prices in the U.S. this month on Kalshi, and they are certainly rising over the last couple days. Odds that we get above $3, or $2.95 rather, I should be more precise, $2.95 now the highest bet here. So look, I mean, the other one's above $3, 50% chance that we're getting above $3. So there's definitely a little concern that things are going to pick up here. I guess I wouldn't be shocked if they did, because we've seen all the other commodities firm up over the last couple months. So,
yeah, but Oliver, $3 is hardly a high or a major spike when you talk about natural gas, right, on a comparative basis. So, I think everything's relative. We got to look at it that way.
Yeah, that's fair. Mark, thinking about the potential for a little government chaos as well. Shutdown this weekend, what is that? Is that going to be like a short-term thing? Because normally I ignore this type of stuff, but the last time we shut down, they like never started back up.
It certainly seemed that way, but we also saw, Oliver, in the months that followed, did it really have a meaningful impact on GDP? Did it really have a meaningful impact on the economy, on the employment picture, even on the market itself? The short answer is no, right? And that was one of the longest, arguably close to becoming the longest shutdown in history. This is a partial shutdown we're talking about. It relates to DHS and some of the related agencies there. This is all over the fight about the president's immigration policy. You saw the president backing off, pulling almost entirely the immigration enforcement out of hotbed places like Minneapolis. I don't think the market is going to care that much one way or the other, but it could lead, as it has when we've gone into other government shutdown periods, a little bit of interim uncertainty, which could increase if you've already got some bullish with the momentum pushing the VIX higher, right? Bullish from the VIX's perspective, bearish from the market's perspective. If you've got vol already on the upswing, something like this can add a little bit more of that lighter fluid to the fire, and I could see that happening. That's why tomorrow and how we close tomorrow going into the weekend is going to be so critical, because it does look like this partial government shutdown is all but a certainty, with the latest spending bill being shut down just a couple of hours ago. Can't hear audio, Oliver.
96.5% chance right now, Mark. 96.5% chance government shutdown. To your point, looks like done deal. I don't hate the idea that might at this point be cause for a little bit of volatility. Again, I generally think the political stuff is very much always dip buying opportunities, but it's just messy. It's a little bit messy, and I would rather things not be messy right now. You've got this massive blow up happening in crypto. You've got an unwind happening in the metals. You've got massive disruption for AI in the equity market. Taken alone, each of these things I do not find to be reason for great concern, but taken all together, they do start to add up. And then you throw in a dysfunctional government again, and it reminds us the last time they disappeared for 45 days or whatever. Or I don't know, how long was it? It was forever. It was a long time.
It was, but I mean, Oliver, my question fundamentally, and look, I'm not saying that vol's not going to continue, and I'm not saying that we couldn't go even lower next week as we test some of these technicals. But my question to you and our viewers is, what has fundamentally changed? The government's been dysfunctional for as long as I can remember. Trump has been Trump during the first time and certainly during the second administration. We know that it's a tape bomb market. We know that we're going to have surprises, whether it's an economic policy or the Supreme Court analyzing and opining on the constitutionality of the president's policies or his executive orders. We know that the government has this shutdown dysfunction. We know that AI and tech stocks are expensive, and you either fall on one side. This is where it's really divisive, and not politically, but from a market perspective and from an AI and valuation perspective. Either you believe that these things are massively overpriced, there's a bubble forming, it's going to harken back to the dot-com days, and this is the beginning of the cracks or the tip of that iceberg, or, as I do, you believe that that is not the case, that the demand for AI, and not just any one component of it, but all of AI infrastructure, supply chain, is actually underestimated in terms of the demand for compute. Things like the latest thing of Claude, the SpotGamma, the Claude crash, whatever you want to call it, that's not going to make us use less compute and less data centers and therefore more energy and more chips and more. It's the opposite of that. Every time there's one of these inflection points where the technology increases, the usage increases, compute and demand increases. So I know they're expensive. It's going to be volatile, but I do not think it's a bubble.
I'm generally with you, Mark, in terms of all that. I think that some of the original cloud companies still were in a little bit of a bubble, and we kind of had to prick that bubble. I think that a lot of them were overvalued. I think a lot of people were getting very, very high salaries for very kind of marginal contributions to kind of to the economy to some extent. Cloud was this massive, complex, convoluted, very high margin industry that now is getting very much disrupted. I mean, think about Silicon Valley in early to mid 2012 to like 2020 basically. It was like insane amounts of bubblicious, and we had the one pop in the cloud stocks after COVID, but I don't really think that was it. That was kind of just the COVID extremities unwinding. So to your point, the stuff that's being built right now does seem more sustainable. And by the way, I've been pulling this up all week. The ISMs right now, I think, speak to that. Looking at the manufacturing versus services, the fact that you got this big boom in manufacturing above 50, I think is just huge. It hasn't happened in a very long time to have them both together. So that to me does suggest that we have this kind of major tectonic structural shift it could be dangerous if you fall in between those tectonic plates, right? That's the brutalism of capital markets. But it's shifting to somewhere that is creating a high productivity and quite a bit of activity, just pure activity as well, judging by this chart.
And listen, I think we're seeing that, Oliver, already playing out. We're more than halfway through earnings season. We came into this earnings season with an expectation of about 8% combined average, sort of aggregate earnings growth. It's coming in so far at over 13. That's the 10th consecutive quarter where the growth has exceeded expectations on a cumulative or an average basis by more than 4%. That's why we have a slightly higher than what I think the street's average is in terms of GDP growth for this year. I think we're probably closer to where what Goldman is looking for in a 2.6, 2.8% range. Could even go higher when we start to see interest rates come back down to earth and we see more of the impact of the big beautiful bill, neither of which I think has been fully priced in. But make no mistake, vol is here to stay. And as smart money traders, we like volatility. We make money in volatility, not in markets that either go sideways or just go up.
Yeah, well said. The volatility does create lots of opportunity for sure. The GDP comment, by the way, just pulled up the estimates for growth on Kalshi for Q4. This is right now above 2.5%, is at 64%. There's a 40% chance it could hit above 3.5%.
Like that.
I would generally take the over on this, I think, right now. I don't want to fade it. Unemployment dropped as well. So I'll give you last thought there.
My only concern with the employment stuff is I'm not sure that the impact of AI taking jobs is baked in as good as or as effectively as it should be, because as you know, the way that we calculate and monitor employment data and the health of the employment economy in this country is antiquated and inaccurate. And every time we get a headline, oh, Amazon just cut another 40,000 jobs, pointing to AI as the reason, it takes the air out of the room. And people go, oh, my God, how is this possible? I think it's going to be even more pronounced than we realize. I just wish the Fed would recognize that and have the influence it should on their monetary policy.
I mean, it looks like we're going to be getting some cuts once JP gets replaced.
Not as many as I would have hoped. Not as many as we would have hoped. The Fed Watch tool, as you know, right now, if I remember correctly, we're only looking at 225 basis point cuts this year.
Right.
I'd like to see a hell of a lot more than that.
That's where we differ a little bit, as I know you know from our previous conversations. I don't think we need to be cutting, but heck, why not throw a little gas on the fire? Appreciate you, Mark.
Always a pleasure, Ollie.
We'll push that debate to the next one. Thank you very much. Love the thoughts. Good thoughts from Marc Lopresti, CEO at Market Rebellion, as we see the economy. Definitely, it seems like most signs are that it's warming up. I got Hans Albrecht joining on the Zoom here. Let's take a quick look at the market, by the way, because we did slip there just over the last few moments. We are back near the lows of the day. which is certainly frustrating as a small bid pretty quickly faded. And we're right back to the lows of the session here with the S&P 500. I'm looking at the futures just above 68.60, which is not giving us much. Mr. Hans Albrecht, CEO of Options with Hans. Hans,
Hey.
is this gonna get messy?
I think it could. You know what? I tweeted a few days ago, and I showed that neckline on the XLK on the mags. You talked about the mags, and I said I don't think there's a small chance that we actually break that neckline. I've been adding to my shorts. We talked about software last week, the week before, and I said I'm not so sure about this bounce. And I think there's something very serious going on. If you look at the equal weight triple Qs, I think you can see that there's sort of been a bit of a contagion within the index, right? So it's kind of started off as software, and it's kind of spread to real estate and legal and some of these other things. I know it's kind of software related, but it's starting to actually kind of be less localized to software platforms and companies that are sort of specific in that area, and kind of reaching into bits of the economy, right? So like, you read about people that are saying, listen, now this thing for $20, you can do legal work that I used to charge $500 an hour for. So I think there comes a point, and I've written about this for about a month now, that where the disruption starts to maybe unsettle things. And I think you're starting to see a little bit of that in other areas of technology. So I think technology is really, really a tough place right now.
And I'll give you credit, the disruptive kind of force that you talked about, I think, is becoming the main story. We looked at a company like Adobe, who's been taking it on the chin now for a couple of years. This is kind of, I think, the still paragon of the AI disruption. It was very early on. It was a very easy one to see coming for anybody who uses these applications, because the first thing we did with AI, of course, was we made memes, videos, graphics.
Exactly.
And that was where the writing was on the wall. But it took some time, I think, to see the power now of the later versions of AI that are able to bring down some of the big giants. Salesforce, though, at least stable today. In terms of this group overall, Hans, should we be fading Microsoft further? I mean, should we be fading Alphabet further?
I've been fading Microsoft myself. It bounced to 423, 424 the other day, and I got out of some longs that I had. I took a little hit in the longs. I was a bit sort of feeling like there's a sort of a toll booth story here, where these guys are at least a little bit integral to the foundational layer of even agentic AI, right? You sort of need cloud, you need the highway. We talked about the highway. You're starting to see now that that story may not be as solid. You can sort of buy a very souped up computer. You can run agents locally on your computer. You don't need the internet. You don't need the cloud necessarily. And I know that's not something that you can extrapolate and say the rest of the broader economy is going to do something like that. But I think it's just getting to the point where we've had this trade for 2 or 3 years that has been kind of bulletproof, and now it isn't anymore. These guys are spending like crazy in an area where AI is just going to get cheaper and cheaper. So I think what happens is the investors start to really wonder, is this going to pay off? We know it's paying off for Google. They have enough fingers in different pies to have it pay off. So they're quite resilient. But I think people start to wonder, is this actually going to pay off when everyone, there's almost an existential thing going on in those boardrooms where it's like, we better win AI. We absolutely have to win. And they're going to spend whatever it takes to win. And that's not settled. That's not sitting well with investors at the moment.
A race to the bottom, kind of, it sounds like, to some extent.
It is. It is.
In terms of just, the payoff profile for that investment, possibly. The good thing is that a lot of these companies are extremely well capitalized still. They wouldn't be able to do this if they weren't. If the alternative, as long as the economy stays firm, which it looks like it's going to right now generally, then I would think the market will either rotate into other places or will eventually come in to buy these dips. I guess what's kind of got me worried here today and this week is the stuff that had been working well, like XLF, is getting blasted. So there's just fewer places to hide right now. Maybe like a utilities up today. Do we really want to go like super safety trade at this point, Hans? XLP looks nice.
It looks good, but I mean, they've even been pushing into some of those areas already. And that's the problem, is that I think you've got a market where you've got some cockroaches and quite frankly, a lot of problems surrounding the AI sort of builder, the sort of, creators of AI and the software companies, et cetera. You've got a lot of problems there. And then the rest of the economy, we've been talking about this move into, Quanta and Caterpillar and ETN and GEV. I mean, these have been great trades that I've been calling out, and we've done great on those. The problem is they've had fantastic runs as well. So you've got this market at a bit of a crossroads. And what you're noticing is that the index itself doesn't really it's not the year for the US index. So think about it this way. The US has had the cachet of being the heart of the digital world in the economy. And that's really benefited US markets for years. But what happened last year, Oliver, is everybody started to shift. Every other market did well. Why? Because physical stuff really lives in other markets. Brazil, a lot of these markets did well. And so I think this year, you may get a continuation of tech being a difficult place. It's not cheap. It's cheaper now, but it's not cheap. And people are trying to cheat that by kind of looking for the areas that can still make sense, right? Some cheaper areas that have been forgotten for years. But it's a bit of a massive amount of dispersion going on that from an index level kind of hides. Like, I know people who are getting absolutely smoked in their portfolios with markets almost at all-time highs. So there's some serious stuff going on under the hood.
I like that you brought up the international trade. Let's run with that for a moment, Hans, because you mentioned Brazil. Brazil, despite today dropping in the last several weeks, has looked very good. Chart there, very solid. If you go to an EFA, just brought it out generally to beyond the U.S., it's been a good couple of years, and the chart looks much more intact there. The 52 weeks is basically, well, now with the S&P kind of flailing a little bit, EFA is looking pretty good by comparison for the 1 year. For the multi-year, they're about the same. But I got to say, if you're looking for momentum, rest of the world kind of looks better right now.
It looks good, and really, I think it's all about, and this isn't anything new. We've been talking about this for a couple of months. It's all about these areas that are just very, very challenged, and saying, well, where's the durable growth opportunity? Well, we know that the AI build out is coming. Alex Karp the other day said you can't come in second, and I'm sure Trump feels the same, and his crew feels the same. This is absolutely full bore into building infrastructure, into retiling the world. And so everyone's just feeling a little bit more comfortable with things they can touch and feel, things they can drop on their toes, as I like to say sometimes. And that's very real. And that also is spreading to other things like the sports teams and, I mean, all these staples and things like that. People want real. They're a little bit tired of areas that can really get disrupted. As soon as another version of Claudebot comes out, everybody goes, well, now insurance is screwed and now legal's screwed. They don't want to be a part of that. So we're moving into an area that has durable growth because the build out is 5, 10, 15 years, and they're much more comfortable with that. Corning, glass, is it exciting? No, it's not exciting, but we're going to need a crap ton of it. And there are even areas of tech that do well. I don't know if you've been watching the photonics areas.
Yeah, I didn't realize Corning was breaking away from its moving average as hard as it is right now. That chart's looking pretty great.
Well, you know what it does glass. So grab all your glassware because it's going to be worth something at some point. But basically, you look at the area of photonics. So I've been recommending LITE. And COHR, which are in the photonics. So what does that mean? Well, we're going to be creating compute just went infinite. So Mark talked about that. It's literally going to be infinite. Dial that back a little, and that's how much compute demand we're going to have. That means endless amounts of data, and we need to move data quickly. So photonics is an area where you start to use new technology because copper is not going to cut it for some things. And so there are areas of technology that are still very, very interesting, but as a whole, it's a really, really tough trade right now.
Yeah. Hans, you mentioned light, and what was the second one real quick before I let you go?
COHR.
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 Coherent. Nice.
Yeah,
I didn't know that one. I know Lumentum, but I didn't know Coherent. Charts that have held their 50-day moving averages. We'll put those in the same category. We're eager to find charts that have held their 50-day moving averages. Go ahead, Hans.
I'm going to give you two more free ones quickly. So another couple. So as you start to sift through software and the software adjacent kind of stuff, I like Cloudflare and Akamai. Akamai having a really, really nice run today. think of software, I wouldn't want to own Adobe right now. I could be wrong. Maybe it goes up one day as they figure things out. But I want to own the policeman of the internet. That's Cloudflare. That's Akamai. This is as compute
security,
gets bigger, as people use more compute, they're going to need that stuff. So, and we know cybersecurity is going to be an issue.
Yeah, I didn't realize that Akamai also, that chart looking real nice right now. Not a lot of tech names that are doing that, especially with cloud connections. So I guess if our robots are going to run wild over the internet, we're going to need some police. I like
That's right. Call the popo. Call the popo.
Hans Albrecht, very nice. Okay, good eyes on some good trades there. Stock staying above the 50-day moving averages. Appreciate it, Hans. The CEO of options with Hans. Good look there. Some of the stocks that I missed on my radar. We got about 12 minutes into the bell here. Let's keep it going. We took our breaks when we were dealing with sound and tech issues of all forms at the beginning. So let's keep it going with some stock trading. I got Mr. Charlie Moon joining me from the Prosper Trading Academy team. Charlie, obviously always a good guy for the tech conversation as well. Charlie, what up?
What's going on, Oliver? How's it going?
Man, we're watching this market flail, a tough finishing kind of session here. It's not looking great, Charlie. Tell me what's top of your mind.
Well, to kind of follow up on Hans, there are certain segments of AI that's doing well. The optics are one of them. So he had mentioned COHR, LITE. Two other names to also look at would be Sienna, Charlie India, Echo November, and Applied Optics, which is AAOI. Both of these are trending really strongly and performing well. It just seems like right now the market is in a bit of rotation. We talked about earlier as well, where's the safety play? Well, with the volatility in precious metals, they can't convert there. But I don't know if you've noticed, but the 10-year futures, the treasury notes, have been moving strongly. The volume in that futures contract has jumped quite a bit over the last month, was averaging around 1.5 million, now averaging 2 million in volume and ascending. We're seeing the outliers really in terms of strong performers really being labeled in the staples. You actually had Apple in that basket until the Siri news, but it's hard to explain how strong Pepsi Cola is right now, how strong Walmart.
Yeah, they're loving the staples. They're loving the staples,
And they're just piling it in. And I actually see the direct correlation. I see these tech names move lower, the market moves lower, and then I just see Costco and Walmart bid up and make new intraday highs while the market's down 1.5%.
Wow. Walmart up $5 right now, 4%. I guess you got to find a place to hide out if things are going to hit the fan. And Walmart's got everything under that fan. 4%. By the way, it's not just today. This is great eyes on this one, Charlie, because you love things that work on days when the momentum trades are down. But then you also love even more things that work on days when momentum's down that also have momentum behind them. Because Walmart's been doing great for 9 months.
And it's funny, this translation, especially with the way Walmart has performed, it's since they got added to the NASDAQ 100, it's almost been a game changer for them. They're trading with a little bit more velocity, a little bit more volume. Their average trading range used to be, right around $2. That's expanded 50% to being around $3 right now. And so, the market is just looking for somewhere to put their money. Retail traders are looking to trade, at least more consistent momentum. We've seen a lot of the back and forth trading with, the tech plays, especially anything related to AI. The Claude news has spooked everybody. We talked about earlier this week, the SAA apocalypse. Well, I think it's now leaking into the financials. If you look, it's not really so much the banks. The banks are weak as well. They're actually turning down a little bit more. Morgan Stanley is probably the name to watch because of the fiduciary services. But then, put in names that you just normally wouldn't see trade with volatility. Charles Schwab, in the last 3 days, have wiped out almost 3 months of gains. Ameriprise, AMP is another one as well that's wiped out, in the last 2 days, a month and a half of gains.
Yeah, so, brutal in that.
And again, the only explanation is that is almost like the Claude effect, that these fiduciary services, why pay someone to manage your portfolio when perhaps Claude could help you make your 5 to 7% safely in the markets. We're just seeing the markets right now react violently and making extreme corrections because they would rather correct too much than correct too little. And we're just seeing this leak. I think that this is only going to be subjected just to tech, and it's being subjected to probably one of the most, concerning sectors, in my opinion.
Agree. Especially because they had been doing so well. I was talking nonstop about KRE, the regional banks. The chart looked great, while some of the other stuff was flailing. And by the way, it doesn't look terrible still. It's still above the moving average. But to see a few of these get really blasted, JP Morgan coming down, maybe to support, I would think that you might get some buying action in some of these financials which have been really under pressure, or which had been doing well rather, and only recently came under pressure. But it basically just leaves very few other sectors working. So it kind of leaves you with, do you want to go in the staples category? In which case I like the Walmart idea a lot. Chart looks good. Or do you want to then start shorting stuff? Because you've kind of only got, if you think the market's going to be in trouble, you've only got a few options, either short or buy stuff you think is going to be to the upside and the outlier. But that list is getting thinner with the banks hurting.
Yeah, and we talk about shorting. Well, you're like, okay, let's short momentum, and then you look into names like Adobe, Salesforce, even IBM. Any of these like enterprise services, they're getting hammered. And so, how many people feel comfortable shorting at these lows after this extended drop? Especially when there's a chance that we could just have this crazy reversal. If you remember last Friday, we finished the day very similar to how we finished today. And last Friday, I believe the Dow finished up 1,000 points for the day. And so this kind of back and forth trading is becoming a little bit more concerning. And you can see it. People are trying to be less active in terms of buying and holding in the markets. There was a statistic that came out today that there's been a 50% jump in zero DTE trading in the SPY since the start of the year. Yeah. And so now more people are just trying to be in and out of the markets effectively. And it's almost as if Wall Street's just matching that energy.
You read my mind there a little bit, Charlie, because I know tomorrow could be an interesting day. We do have some economic data coming out. We're also, at an interesting point for the calendar. Is there anything that's top of your mind in terms of trades that you're looking at into CPI? Which, like I swear, delayed, but, you've got a 95% chance of government shutdown. What's kind of your thought into the week? You got a top trade right now?
Well, JP Morgan came out and actually kind of gave an alarming kind of guidance on what they're expecting for the CPI report. I think consensus is at 0.3% rise. JP Morgan's at 0.39. And they said that, there's a small likelihood that if it measures in somewhere between 0.3 0.35, that the markets will most likely go up somewhere around 0.5% to 1%. But if it exceeds that 0.4 to 4, especially if it exceeds 0.4%, we're looking at a 2.5% retracement in the SPY. And so this kind of leads to more of a read and react type of environment. For me, I love NVIDIA right now. They're at a key support level, and if they could actually balance here, I actually could see them on a bullish day tomorrow finally being able to press through this 194 price to test 196 and 200. On a pullback, the one name that I really love in the sector
NVIDIA real close to 50-day moving average, by the way, is that support. Just adding that.
Right. And they're balancing a bit. And right now, the outlier in the semiconductor sector is TSM by far. They've been pushing to all-time highs here on a daily basis, and they've been looking to work back. And for me, ultimately,
wild move in TSM today.
No, that was a misprint. That's a slip print.
Okay, yeah, I see it.
For sure, I looked at that earlier. That was a slip
right,
print.
Okay, yeah.
But again, this is another one that's been really sustainable in terms of holding up well relatively under these bearish market environments.
Yeah, great chart.
Again, if we're looking to press lower, I think it's got to be names that have popped recently that have been fairly bearish, and like names like Qualcomm come to mind. where they had this big jump and they started rolling back. ARM is another one where they had this big jump recently and they could start rolling back. And so I would just be looking at more longer term sustainable bearish plays that have shown a little bit of strength right now. And again, if the markets get ugly, these are going to have a lot of fuel behind them because the shorts are going to be trying to play catch up and kind of get right back into where they were. That bearish trend is sustainable bearish trend.
Stock that had been weak for the last couple months, hitting them again after they outperformed on earnings. I like that idea. So, for ARM, maybe you pair an ARM short with an NVIDIA long. How about that?
Yeah, I mean, why not? I mean, I think NVIDIA still owns a part of ARM, but I'm not sure if that same shareholder size is still in the picture. At one point, I believe NVIDIA owned more than 10% of ARM. They tried to acquire them, and due to the antitrust, they weren't allowed.
Didn't work.
And so I don't look at the filings. So if they're listed as a 10% share stockholder, that'd be kind of a funny fade, but we've seen it happen elsewhere. We've seen kind of, NVIDIA showing strength with CRWV showing weakness. So that certainly could be a play.
Yeah, all right. Like the look at NVIDIA, the 50-day moving average, hoping that holds, hoping that this market doesn't come apart too much. Should be an interesting session tomorrow. Might have to slide in an extra show, see if we can hold 6,800. Dicey last 10 minutes here as we are at the very lows of the day, just cut to fresh new lows. Tough session for sure, but glad we got good guests and glad we got to get everybody's thoughts. Charlie Moon, thanks a lot, sir, taking us into the bell. Appreciate it very much.
Thank you.
You got it. Prosper Trading Academy. Charlie Moon and crew, thank you for tuning in to Chicago Future of Finance. Okay, troubleshooted some tech, made it through. PIMCO about to ring the bell, 2:59. That means we're out of here. Have a great night.